feels like everywhere you look, there's some form of tumult in the markets, whether it's over in the UK or back here in the United States. And in the middle of all this, we're going to start with bank earnings tomorrow. And to take us through what we should look for in those bank earnings, we welcome now Rodge Cohen. He's senior chairman of Sullivan Cromwell, and as I always say, the dean of all banking regulation. Rodge, thank you so much for being with us. Appreciate it. Give us a viewer's guide here to bank earnings as we go into them. Given what's going on in the markets with increased rates, CPI, inflation going through the roof, a lot of slowdown, what should we be looking for in bank earnings?
Hey, David. Well, it's always a pleasure to be with you. And I think we should start with the proposition that you have asked the correct question, what is going to be the level and impact on bank earnings? Because the underlying strength of the system, the banking system, I think should be indisputable. High capital levels, high liquidity levels, still strong asset quality. But your point is the right one. It is inflation and what that is doing to the price of fixed rate securities, fixed rate loans. There are offsets here. Deposits become more valuable in a high rate environment. And ultimately, as in your prior segment, you suggested, if you were able to start to change the direction of the economy, banks do no better than their customers. And if customers start to have problems, that will start to seep through into bank earnings. But again, the banks are sitting in a real position of strength today.
Well, Rodge, I don't expect you to be a clairvoyant here. At the same time, you understand these banks terribly well. As we go into these earnings, would you expect a trade-off, as you just suggested, between a net interest income on deposits because rates are going up, and I know the banks have been hurting because they have been down at zero, on the one hand, and, for example, investment bank income on the other, because it looks like deals are drying up, and as I understand it, high-yield credit is really cracking?
Right. So let's take each of those pieces. Clearly, M&A has slowed way down. Offerings have slowed way down. And that will have an impact on revenues generated from those businesses. Also, asset and wealth management, as values of the securities go down, fees go down. But as you also point out, the spread on deposits will increase. They do not rise in terms of rates nearly as quickly as the loan book. And so there are offsets. The only other feature I think you do need to look out for is whether there are banks which are significantly mismatched on the wrong side. Most banks try and get to pretty close to even on interest rate risk, but if anybody's been trying to play the curve, they could be in for quite a disappointment.
Rodge, you say that the banking system is in really strong shape overall. We probably won't need to worry about that. At the same time, there is concern about the markets. We saw something break down in the United Kingdom, apparently because of the attempt to really change the budget over there, and the Bank of England had to step in. And there's reports that there's really a shortage of liquidity in U.S. Treasuries. How concerned should we be about that?
Well, if we have to be concerned about U.S. Treasuries, then we have a real concern overall, because I think it is, again, indisputed that this is the single most liquid market in the world. That's not to say it can't happen. We saw it happen in 2020. But I really worry not about the banks, but it's the unregulated segments or the less regulated segments of the financial services industry. You don't know what you don't know. And if you don't regulate, if you don't have information, that's where an accident can happen. You mentioned highly leveraged lending. Banks, I think, for the most part, have quite rigid guidelines on how much they will do. So how much of that has moved out of the banking system to a place where no one really knows?
Well, no one. Does that include the Federal Reserve? Does that include the Treasury? How much visibility do they have into things like some of the private credit areas, the non-bank banks? Because they seem to have been growing leaps and bounds.
I think not nearly as much as they should have. I do think that the Fed and Treasury try and keep tabs on what is going on in the non-regulated markets, but by definition, they don't have the access that they do to regulated institutions.
Going back, my recollection, at least, of the great financial crisis back in 2008, one of the issues was derivatives. And now they seem to have popped up again in the United Kingdom with respect to the pension plans. As I understand it, they went into some derivatives to try to really take care of long-term liabilities. What is the situation on the visibility in derivatives trading today?
It's a lot better. There have been a number of reforms since 2008. You're absolutely right. It started with AIG, but it certainly didn't end there. And it is a way, derivatives can be a way to build up a lot of leverage and a lot of risk. I think there is more insight. There is more in the way of central clearing. But in any instrument which can be leveraged, to a great extent, there is greater risk. It's just by definition.
Finally, Rodge, if in fact we may be headed into a slower period of growth here, even recession, we heard President Biden allow that there might be a recession in the United States. Other people, I think it's a higher chance than that. If that's true, is there any prospect for some loosening around the edges, at least, of some of the regulations on banks, particularly with respect to reserves, so there would be more liquidity in the system, more lending?
At this point in time, I would doubt you would see anything significant in the way of loosening. But what you might see is discouragement of raising regulatory requirements. There has been a fair amount of questioning whether capital ratios should be raised. And if there were anything that were pro-cyclical, in a sense, in the wrong way, in driving credit access down, it would be to raise capital requirements when there is a reduced availability to obtain credit and more need.
Okay, Rodge, it's always such a pleasure to have you with us. Really informative. That's Rodge Cohen. He is Sullivan & Cromwell Senior Chairman.